Good evening, ladies and gentlemen, and a very warm welcome to you all. We, the Colombo Stock Exchange, together with the Securities Exchange and Commission of Sri Lanka, are delighted to welcome you to this forum under the theme From Seed to Scale, Unlock Value and Potential. We invite you to join us in this evening's discussions as we present this unique opportunity to learn from market regulators, facilitators, veterans of the Sri Lankan capital market and IT sector. Tonight's event is a platform to collaborate and engage in dialogue exploring the long-term sustainability of corporate enterprises in today's evolving capital market, covering a range of topics from corporate governance, business continuity, succession planning, and the path to public listing. Before we commence today's proceedings, let us take a moment to watch the following video presented by the Colombo Stock Exchange.
Listing on the Colombo Stock Exchange has consistently been one of the largest sources of capital raising for corporates in Sri Lanka for over 38 years. CSE has in place a flexible, market-oriented and efficient listing process, with an issuer relations practice to guide corporates that are interested in listing. Companies also benefit from the services of a network of established and reputed investment banks with extensive experience in taking companies to market. As a premier source of capital raising in the country, we offer versatile and innovative LKR and foreign currency denominated listing options. Main market segments. The Main Board, a platform for large cap established corporates ready for their next phase of growth. Dirisavi Board, a platform funding the growth of mid-cap companies aiming to be the best in their respective fields. Catalyst, a platform to facilitate SOE reforms. The Empower Board, a platform with relaxed listing requirements to help SMEs take their first step into capital markets. Alternate market segments. Listing corporate debt, Sri Lankan Real Estate Investment Trust, Multi-Currency Board. Other modern fundraising tools. Green bonds, perpetual bonds and blue bonds, infrastructure bonds and Sharia-compliant debt securities. Listing attributes an optimal value for your company at the IPO stage, which unlocks your financial potential. It also provides an independent, market-based valuation as companies' shares continue to trade. This can benefit the ownership for diverse objectives, from raising further capital to pursuing an exit mechanism. A listing on the CSE helps with improving other aspects of your business, including further strengthening of corporate governance, sustainability, improved visibility, and corporate branding opportunities. Boosts the ability to make strategic partnerships, laying the foundation to attract and retain quality talent by rewarding employees through ESOP schemes and more. We invite Sri Lankan corporates to actively explore the wide-ranging choice of listing options available at CSE. We look forward to welcoming you to the Colombo Stock Exchange.
To commence today's proceedings, I am pleased to invite to the podium Senior Professor DBPH Disabandara, Chairman of the Securities and Exchange Commission of Sri Lanka, to address the gathering.
Good evening, ladies and gentlemen. Dr. Hans Wijayasuriya, Chief Advisor to the President on Digital Economy. Mr. Tushar Jayaratne, Officer in Charge and the Deputy Director General of Securities and Exchange Commission. Mr. Rajiv Bandaranayake, Chief Executive Officer, Colombo Stock Exchange. Mr. Ashwant Vijayaram and Mr. Jeevan Jnanam, distinguished guests, panelists, industry leaders, entrepreneurs, ladies and gentlemen. A warm welcome to the Sri Lankan capital market, and thank you very much for accepting our invitation to attend this very important forum, which is specially designed for you, and to discuss how we can gain the maximum outcome from the Colombo Stock Exchange, where we have been experiencing a lot of gains, companies as well as individuals. So thank God, throughout the last 15 to 16 months, we have been experiencing a very good market, calm, and prospects are very good, no disturbance. So with this background, when we think of any capital markets, we often picture balance sheets, regulations, and numbers on screens, millions, billions, and so on. When we think about the technology industry or technology entrepreneurs, we think of creative ideas, codes, innovation, and speed. So now today's conversation sits at the intersection of those two very important worlds. So where innovation meets structure and ambition meets trust. So when we look at Sri Lanka's technology sector, it is no longer an emerging story. It is an unfolding success. From export-driven IT sector, IT services, to homegrown platform and intellectual property, our entrepreneurs are building companies that can compete globally and has made a significant impact on growth of the Sri Lankan economy. The real question before us is how our capital markets can evolve to support this momentum by providing not just capital, but confidence, credibility, and continuity. So when you look at the startups and technology-driven companies are central to this vision. So many of these companies possess immense growth potential and the capacity to become future market leaders, generating employment, export earnings, and innovation-led value creation. We see capital formation not simply as a financing mechanism, but as a strategic pathway for these enterprises to scale, professionalize, and to integrate into the formal market system. So yet, we must also acknowledge that innovation-driven business do not always fit into traditional frameworks, and intangible assets, rapid scaling, evolving business models, and founder-led structures present real challenge for us. So addressing these realities thoughtfully is essential if we are to create pathways that are both market-friendly and investor-safe. So being the regulator, we have to see both these aspects together. So a well-functioning capital market is more than a source of funding. I think I mentioned earlier, it is a signal to the investors, partners, and to the world that a company is governed well, transparent in its conduct, and committed to long-term value creation in the economy. For technology companies, this signal can be transformative. So when you look at the SCC as the regulator and a facilitator, as we firmly believe, our role is not merely to regulate. We have openly said that. But first and foremost, to help create the market, and therefore, thereafter, to maintain the market and to regulate the market thereafter. Our objective is to build an inclusive and dynamic capital market ecosystem in the country that enables innovation, encourages entrepreneurship, and supports sustainable economic growth. As the SCC, we bridge this gap by actively supporting the growth journey of such companies by enabling access to diverse capital raising avenues to enable capital formation while preserving the market integrity. We are committed to a regulatory approach that is progressive, proportionate, and responsive to change while upholding the standards that sustain investor trust and confidence. So today's forum is therefore not just a discussion, it is an opportunity. So therefore I hope the representatives from the tech industry gain the maximum outcome, an opportunity to align innovation with regulation, even though it is difficult, growth with governance, and entrepreneurship with long-term market confidence. So I look forward to insights shared today and to strengthening the role of our capital market as a true partner in Sri Lanka's technology-driven future. So at the very end, I would like to mention 3 examples. In Sri Lanka's capital market, we have, in the Sri Lankan economy, we have 953 startup companies, according to our records. So when we look at the listed entities, we can see HCL Business Solutions, if I am not mistaken, it is listed on the Colombo Stock Exchange main board. So market capitalization is 6.75 billions. And when we look at the e-channeling, it's 2.16 billion. And very recently, in the Empower board, we have Insure Me Insurance Brokers, that's 3.6 billion. So these are some success stories in the market. So my invitation is, you must be more than that. So regulator is here, we are flexible, we would like to see how we can help you all. So that is our intention. So together with Digital Economy Ministry and with all other stakeholders, our attempt is with the market operator to find out the best solution. So hope you all will constructively join with us and find solutions. Thank you.
Thank you, Senior Professor Disabandara, for your opening remarks. Ladies and gentlemen, I am now pleased to invite on stage Mr. Ashwant Vijayaram, Senior Vice President and Head of Equity Capital Markets at Capital Alliance Holdings Limited, to deliver the main presentation of the evening.
A very good evening, everyone. Pleasure to be here. While I was putting the deck together for the presentation, I was reminded of a conversation I had with one of my friends who was in tech back then. I asked, he was like, there are 3 times during a life cycle of a tech company where we think about raising funds. It's when we start, it's when we scale, and the payroll is next week. Now, in a world like that, I'm glad that all of you are here thinking about what to do next, when to raise funds, and how to go about raising funds. And I'm happy that the CSC has facilitated an event of this sort for targeting specifically tech investors as well. Now, without further ado, I'll go directly into the presentation. And before I go into the details, a very quick brief in terms of what capital markets are now. If you look at capital markets, there is a primary market, there is a secondary market, and then you have the market participants. Now, a primary market is generally where funds are raised and the funds actually go into a company for use. Although there are secondary markets, the secondary market trading or fund movements don't really have an impact on the company. But having said that, should a company be focused on both the primary and the secondary markets? Definitely yes, because it's the primary markets that give you the funds, but it's actually the secondary markets that keep adding value to the company. So it's very important that a company focuses on both the primary and the secondary market, and where all of these, where the primary market is, where the secondary market is, and all of the key players of the market, including the regulators, investment bankers, intermediaries, companies, where all of them come together is essentially what the capital markets are. So that was a quick brief before I go into some of the details. Now, a tech company goes through a life cycle, and the life cycle for each tech company is quite different by itself. But generally, if you look at a tech company, it would generally go through 4 different phases during its life cycle, and it's very important for a company to look at the 4 different phases in the life cycle, because the kind of funds that you would raise would also depend on which part of the life cycle that you currently are in. Now, the best tech businesses that have come up, one of the reasons that they've come up so far is because they were smart in terms of attracting the right kind of capital at the right time. Now, despite it being an event organized by the CSC, I would say if you're just starting a company and if you want to do an IPO for a company, that's a definite no. If you're in your early stages of the company and if you're looking to do an IPO, would I advise you to do an IPO? Maybe, depends on the company, but it's most likely going to be a no again. So where does an IPO come in, or where do different rounds of funding would actually come in? Say you're starting off, your focus and the kind of capital that you're going to attract is going to be very different. When you're starting off, the things that you're worried about is vision, product, early traction, that sort of thing. And what kind of capital would you be attracting? You're probably going to be bootstrapping your company, or you're going to early stage investors like angel investors, for instance. Now, in the first couple of stages, the investors who are going to invest in your business is highly risk tolerant, but the risk tolerance also comes at a cost, because the early stage investments are quite expensive. This is why, as businesses progress, you then look for less expensive capital where the risk tolerance might also not be high. So would you be going to the same investors during different parts of your life cycle or different phases of your life cycle? It's a definite no. So in the early stage, you'd probably be looking to raise, now don't hold me to these numbers, I'm just basing it off the Sri Lankan context. There are some businesses in Sri Lanka, maybe even here, where an early stage funding round would require ₹1 billion to start if it's a highly capital investive tech-driven business. But basing it off the general tech businesses here in Sri Lanka, you may be looking to raise about 5 million or 50 million when you start up. You're most likely going to have to bootstrap that business. The next round are what we call the seed rounds, which could be seed A financing, B, C. Again, the risk tolerance of investors is relatively high, but the kind of capital you're also looking at is generally low, meaning your dilution is going to come at a higher level compared to when you go into the later stages of financing, which would attract the likes of private equity funds or institutional investors. So at the early growth sort of phase, your focus is mainly around repeatability of revenue. So you established what you can do, everything is done, now you started making revenue, but how much of the revenue can be repeated and for how long and in which geographies is what the investors would look for. And when this translates to private equity is when there is a lot of governance that comes into play. Now, a private equity investor compared to the first two investors is less expensive because the dilution that you're looking at that point in time is not going to be great. And this is when you start thinking about different structures to put into the business. In Sri Lanka, the general norm is, okay, you have debt, you have equity. And when you look at debt, you have bank debt. When you look at equity, there's straightforward equity. But there are so much in between. Debt, there are multiple layers of that you can go for. There is equity, there are different forms of equity. Now, equity could be voting equity could be non-voting equity, there could be preference shares which are converted into equity. All of these things you need to start thinking about when you go into the third phase or the expansion sort of phase where you're attracting, say, private equities. Because these are the guys who are going to come in with the view of an exit in a couple of years' time, and they know for them to exit that there needs to be corporate governance practices already in place because their exit is more often than not going to come in two different forms. Either an IPO where they exit, where you give them liquidity, or a trade sale. For either of those situations, you're most likely going to have all the corporate governance practices in place and have the company restructured where it's no longer a startup per se. Now, in tech businesses, I do understand that the time it takes for you to be irrelevant is very small. But having said that, corporate governance practices need to be in place where they also evolve with the nature of the company or the state of the company. Now, once you bring in these private equities, eventually you're going to have to look at an exit for the private equities. That's where an IPO would come into place, and an IPO would not give them, yes, an IPO can give people an exit, but it's not an exit per se. It's an event of liquidity for not just the private equity guys, but for all shareholders in general. Now, how it will help you, I'll get to the benefits of the IPO in a later slide. But yes, if you're looking at an IPO, you're coming to an IPO at a stage where your business is relatively stable as opposed to your previous stages. Because now, the people who are investing money also include the general public. And the general public is not as risk tolerant as some of the other investors that you've had in the previous life cycles. But the general public is also not very expensive. So your dilution for a large estate could be lower compared to the previous dilutions that you've had in your company. Now, I did mention there are different forms of financing. You have debt, you have equity, you have everything in between. Now, a little bit of clarity around that area. Now, you have debt financing, and debt financing doesn't necessarily have to be a bank loan. There are different forms of financing, and you see that in some of the local companies here as well, although this is more frequently seen in other countries. Now, you have venture debt, which could be straightforward debt where you're basically borrowing money, but you're a startup, so it's going to come at a higher cost compared to some of the more mature companies. But there are other means of financing, like, for example, revenue-based financing. Now, say you have a subscription-based business model in tech. There are certain debtors who would be more than willing to lend to you on the backing of the revenue that you get from the subscription. So you're basically going to securitize or create a security out of your revenue that you will most likely get. Because especially if these subscriptions are relatively sticky, some of the lenders might want to finance you, not the finance being backed by a real asset, because as a tech company, you might not be having real assets like, for example, land or building, but your asset might actually be the future cash flows that the company can earn in the future. So you securitize that to borrow against. That's another form of financing. Then you have corporate bonds. Now, corporate bonds in Sri Lanka are generally issued by listed companies, which includes you getting a rating, Now there are both listed bonds and unlisted bonds, but in Sri Lanka you find more listed bonds than unlisted bonds in all honesty. This includes you getting a rating, you eventually listing the bond on the exchange. Now it could, now it's not necessarily that the company itself has to be listed on the exchange for you to issue a listed bond. There are companies which have listed only their bond, but the company itself is not listed. So the security is listed, but the company is not. So there are mechanisms like that outside of the traditional banking sort of lending, which you can go for even when it comes to debt sort of lending. Now, if you slowly shift away to equity financing, again, there are multiple avenues that you have. Earlier, you're going into angel investors, venture capital funds, and then you're shifting to private equity. And when it comes to private equity also, what you need to be mindful about as a business, as you're starting up, as you grow, and you're in your, say, 4th or 5th year, is how much should you really be diluting at that stage? Now, someone could come in and say, okay, I'll offer you X amount for 49% of the business, you'd still be the majority shareholder. But that basically removes your ability to raise any further funds without coming below 51%. And I'm not saying that coming below 51% is a bad thing. Now, there are large companies even listed on the US where the majority shareholder would own much less than 51%, but they still have control of the company. But some mechanisms that they've adopted would be issuing non-voting shares, which essentially dilutes your ownership, but doesn't dilute your control. Or you can look at options of issuing convertible preference shares. So you go and tell an investor, look here, I'll issue you preference shares, which would convert at some point in the time, but it would convert at whatever the valuation the business is going to achieve X years in the future. Now, if you actually performed and have stuck to the kind of numbers that you gave as the forecast, your preference conversion is going to be a lot more lucrative than you having diluted more in terms of equity at an earlier stage. So these are some of the mechanisms that you can actually adopt even whilst raising equity financing. Now, broadly, if you look at most companies, although I spoke about both debt and equity financing, a vast majority of tech companies that has seen immense growth has gotten equity financing at the start, and it's the equity financing that has enabled the companies to grow as well as opposed to debt. And it comes because of a couple of reasons. One, as a startup, you don't have repayment burden. But having no repayment burden doesn't mean that it's less expensive than debt. Equity is actually more expensive than debt because what you're losing out is actually the ownership of your company. So you're diluting more ownership. But when you're a startup, or even as you go through the phases of a life cycle in the tech business, getting significant amount of borrowings at the start dampens the kind of cash flows that you should be making, and it also prevents you from growing further because then you're always worried about the repayment cycle of debt. So yes, it's not a matter of whether you shouldn't borrow at all, but at different life cycles throughout, it's a matter of where do you think that optimum level of debt to equity is. Now, at an earlier phase in your life cycle, the equity mix generally seems to be higher, which is why companies that have grown significantly at an earlier stage, the amount of debt they would have taken would be relatively lower. But as they grow, as they become more structured, as your earnings become more recurring, then the amount of debt that you can take also becomes higher. So the optimum capital structure of a tech company also changes throughout the life cycle, where you start with almost zero debt and eventually leverage your company as you move forward. Now, equity financing, like I said, no repayment. So it doesn't give you or it doesn't put a damper on your cash flows at the start. One other thing, as a debt holder or as a person who has lent to your business, my goal at the end of the day is going to be recouping whatever that I've lent to you. But as an equity guy, my end goal is pretty much the same as your end goal, because we both want to see the company grow, because my return is pretty much reliant on the business performing as well. which is why a lot of companies at the initial stages or tech companies rely mostly on equity because you don't have repayment obligations at the start, and you also have someone who's sitting on your board maybe whose interests are aligned basically with your interests, and that helps the company grow at an earlier phase in your life. But gradually as you move along the life cycle, like I said, the amount of debt you can take can also go up. But it's not always easy having an equity investor because on one side you're diluting ownership, on the other side now you're going to have someone sitting on the board or someone coming into a shareholder meeting asking you a million questions. But does that mean that you lose out on your ability to make decisions fast? Most likely not, because these guys who are going to be sitting on the board would be sitting on the board from more a governance sort of aspect as opposed to sitting and actually running the business. So you still have the freedom of running the business, but from a more governance point of view, the institutional investors would come in and would address a couple of things for the company. So those are some of the features of equity investments. Now actually moving on to a topic that is highly debated, not just in Sri Lanka but globally, is how are businesses valued, especially tech companies. Now, and it's important because tech companies are fueled with equity investment as well. Now, how one would value a tech company at an early stage is very different to how one would value a tech company at a later stage when you're in the later part of the life cycle of the business. Now, I earlier said that at an early stage, I wouldn't recommend a tech company to go and IPO. Why? Because when you go to public markets, there are certain metrics the public markets look at. Like, for example, the public markets would look at how recurring your business revenue is, or how stable your business revenue is. How much growth are you going to achieve over the foreseeable future? They would also see what your valuation is. So the go-to when it comes to most capital markets is to see, okay, what's the price-earning ratio of the business? Now, can I go and apply this to a business that's starting up or growing or scaling or in its initial phases? Is a definite no. Because the kind of numbers that an early stage investor would be looking at would have nothing to do with earnings, because most companies wouldn't even have gotten to a state where they're actually making earnings. So there are other metrics that they would look at, and it's very important for any tech company to measure these and keep these at any given time, because any investor is going to want to look at those numbers. So the most common things that people look at would be, what is my customer acquisition cost? What's the long-term value or the lifetime value of a client? They would also look at things like what your annual recurring revenue is. Is that growing? Is it sticky? Is it subscription-based? The other thing that they would also look at is what your business model actually is. Now, I've seen in Sri Lanka especially, there are different types of tech companies, but not all tech companies are valued alike. Now, one person might have a tech company which is, say, a trading company where you're distributing or selling Microsoft products or SAP-related products. Now, there might be a different tech company which has built a software, a proprietary software, and is catering to different segments in the market. Now, if the company that sells Microsoft products says it's a tech company, so I need to be valued at the same level at which another company which is doing proprietary products is being valued at, it is almost next to impossible. Because at the end of the day, when you come to market, the market is going to look at this business very differently as opposed to that business for multiple reasons. One, you have a proprietary product. Two, your scaling is going to be very different. Now, say I'm a reseller of products here. What is my scaling option? Yes, I can become market leader in Sri Lanka. Say I have a proprietary product. What is my scaling option or growth story? I can basically sell this product in any part of the world. That's my growth story. So the business model also determines how your company is valued. And another thing a lot of people look for when they invest in startup company is definitely the quality and quality of the founders. I mean, that's a cornerstone of any good company, where the first thing that people look for is, okay, I've met some investors who've looked at startups or even tech companies. The first question they ask is, okay, who's running the business? Because as a startup, it's very important who the shareholders are and who's running the business. Yes, it is important even as you grow and you want to eventually list the company, but eventually when you list the company, the focus moves away from owner-led company to who is actually managing the company. So at the point of doing an IPO, the owner might not actually be managing the company. It might be an entirely different CEO who's managing the company, and people's focus will be there. But at the start, it's mostly who the founders are and who's running the business. Now, let me go into how listing comes into the picture for tech companies and what the options are for tech companies on the CSE. Now, there are a couple of decisions that you have to make before you list your company. Let me go into the next slide because it's a lot easier to explain, and then come back to the previous slide. So one of the decisions is, how do you intend to list? Now, there are different mechanisms that you can use to actually list on the CSE. One mechanism is where you're doing an offer for subscription. An offer subscription is basically another way of saying money is coming into the company. Then you can do an offer for sale. Now, an offer for sale is a scenario where there is no money that is coming into the company that is being listed, but investors are basically buying shares that were previously held by the existing shareholders of the company. Now, if I was to give two examples here, companies like Winforce did an offer subscription where money went into the company, and that money then is used for the expansion of the company. But if you take PickMe, which did a listing recently, it was an offer for sale. There was one party who wanted to part divest some of the shares that they held in the company, so they divested it by way of an offer for sale, and then eventually listing the company. Now, there is another mechanism where there is no fundraising involved, which is called an introduction. Now, say the purpose of listing is not to raise funds. You have enough funds. There are no shareholders who want to exit. But you want to list because you see listing as a mechanism of putting your brand out there. Even that is possible because now you can list a company by way of an offer for, or by way of an introduction. Meaning there are no funds raised into the company, there is no sale by existing shareholders. As long as you fulfill the requirements, you basically go and list your shares in the exchange. While once you list your shares, you've given liquidity not just for your shares, but the liquidity for all shareholders of the business. So those are the three mechanisms using which you can list a company on the stock exchange. Either raise money into the business, facilitate an existing shareholder to exit, or just list the shares of the company. Now, that's one decision that you need to make. There is another decision that you need to make in terms of which board are you going to go and list on. Now, which board you're going to go and list on is not a decision that you can make per se, but it's something that you have to fall within because there are certain criteria proposed in the listing rules, and as long as you fall within those criteria, you can list in those segments. Now, the main board and the Dirisavi board, I'll take the main board and the Dirisavi board and the Empower board separately, because the main board and the Dirisavi board, the requirements are more or less very similar. Irrespective of whether you list on the main board or the Dirisavi board, your compliance requirements are very similar. But a Dirisavi board enables smaller companies to list whilst maintaining the same level of compliance that is required of a main board company. The Empower board, on the other hand, is structured for even smaller companies to list. Now, an Empower board minimum capital requirement is in the range of about 25 million to 200 million. Whereas both Dirisavi and the main board requirements are significantly higher compared to that. Now, main board requires you to be profitable as well, or you have to have positive operating cash flows. The Reserve Board requires you to have positive NAV, but on the Empower Board, some of these rules are relaxed. But again, when you want to list on the Empower Board, there is one thing that you need to do, which is to get a sponsor to help you with the listing process and post-listing. So an Empower Board is basically a board created so someone can handhold you through a listing process for relatively smaller listings, where you can list the company and eventually grow. And once you grow, then based on your performance, you can move up to either the Reserve Board or the main board. Now, all this time I said, this is how you can list. These are the things that you need to think about when you're listing. But I guess I also need to mention what are the benefits of going public. One, you have access to growth capital. So currently, for every funding round, you might be speaking to different people. Once you go and list your company on the exchange, there are multiple things you can do. One, you can do a rights issue. Yes, you will have to participate, but there are others who will participate as well for the rights issue. You can do a private placement, and it's relatively easier to do a private placement for a listed company because there is already a market-determined share. Whereas if you're going or taking a private company to do a private placement, you have to first justify what that price is. Now, even for a private placement, it's not that you get the same value at which the share is trading at the market as of today. It will be different, but at least there is a basis to initially stick to or to anchor to. Two, enhanced valuations, and that mainly comes from one factor. If it's a private company, your valuation is always going to be discounted because of the fact that you don't have liquidity. But the moment you list a company, you have liquidity coming in the form of shares that are traded freely in the market. But practically, if you do want to have that liquidity, in my opinion, there is no point in listing a company with a 5% free float. The entire free float is 200 million, 300 million. Doesn't really command confidence when you go to investors saying there is market liquidity. Market liquidity also would come where you have enough public shareholders in the market actually buying in shares on a regular basis and creating or determining a price for that security. So with liquidity, yes, there is enhanced valuation as well. There is also brand credibility. The moment when you list on the CSE, a lot more people know about the brand. Now, I don't come from an IT company. I come from an investment bank. We didn't have our company listed for the longest time, but I can say having or being listed has created brand credibility mainly amongst the retail segment in Sri Lanka as opposed to the institutional segments. So yes, if you do want brand credibility around the retail segments, if you want to be known to the people, listing on the stock exchange, yes, it does give that benefit. Then on talent acquisition, now, according to the CSE rules, you can have up to 5% of your shares, if I'm correct, as ESOPs. Now, most tech companies have ESOPs, but these ESOPs sometimes are not liquid. Yes, I can have ESOPs. What difference does it make to me if I don't get to exit at a particular time and if I can't realize the ESOPs that I have? So CSE is a mechanism to also provide liquidity to ESOP shareholders and thereby enabling you to recruit talent as well. I've already spoken about shareholder liquidity, same thing. When there is liquidity in the market, there are more investors willing to trade on your shares. And then strategic flexibility, which is an important point, which a lot of people miss. The moment you have your company listed, now your company is worth something, and that worth is determined by daily trading in the market. And it not only allows you to use the shares of your company as a currency, where you can basically say, look, I have my shares listed on the exchange. I want to acquire your business. I'd be willing to pay for you in the form of shares, which are already listed on the exchange. There is another thing that a lot of people don't think about, is the moment you have your shares listed on the exchange, the ability for you to pledge your shares and get a bank loan out of that also goes up, because a private company's value is determined by a valuation report, and no banks have any indication as to whether it's the actual valuation, whether we'll be able to get that money out. But the moment you have it listed, yes, there is a trading value or a market capitalization that's on the stock exchange, and you'll be able to borrow against that as well. So that's another benefit to having your company listed as well. Another thing that is often goes often not looked at is the tax efficiency of having your company listed. Now, if your company is held through another company, when you exit that company or when you sell that company, you have to technically pay a 30% capital gains tax. And if you hold that company under your individual name, you have to pay a 10% capital gains tax, which according to the budget last year, if I'm correct, is going up to 15%. Whereas you exit the company after you list the company, you're technically paying a share transaction levy of 1.12%, if I'm correct. And that's all you're paying. There is no capital gains tax that arises out of the transaction. So that's another benefit of having your company listed. Now, a quick brief in terms of what an IPO journey would look like. The first phase is generally the preparation phase. Now, the entire IPO process can take anywhere between 6 to 12 months, and for certain companies, 18 months, depending on how much preparation is required. Now, a preparation would essentially mean you having to do a legal due diligence or a review of your accounts. If you already don't have accountants who are recognized by the SEC or the CSC, you essentially have to do an audit with those accountants, which adds more credibility to your business. There are other matters where you need to prepare, where you may have ESOPs of, say, 25%, 30% of the company. But once listed, you can only have ESOPs of 5%. So what are you going to do about it? Are you going to convert those into shares? So eventually, people can realize those ESOPs. So all of that restructuring happens at the initial phase. Now, after that, you have to restructure the corporate governance of the company. Now, some companies, especially if they've already attracted private equity funding, may already have some of these corporate governance practices in place. You might already have a related party committee, you might already have a nominations committee, you might already have an audit committee, but if these are not in place, then you have to take that time to put those into practice, and for the company to run a couple of months with those practices in place before you actually start thinking about actually apply for a listing on the stock exchange. So that would be the next phase of the IPO journey. Then you go to an investment bank and basically ask the investment bank to see what the value of the company is. Now, I have seen instances where promoters would walk up to an investment bank and say, look here, I want to raise X billion for a dilution of 10%. And it generally doesn't work that way. It generally works the other way around, where you let the investment bankers do a valuation, come up with a valuation, and then you decide what the dilution is going to be. Now, if you can't take that amount of dilution, then you start thinking about other options like having preference shares, having non-voting shares, and so on. But you never start a discussion with an investment bank saying, okay, I want to raise 10% and I want 2 billion. Basically, you arrived at a valuation by yourself and you want an investment banker to basically raise funds. So always go with an open mind in terms of what the valuation of your company is, and then let it come as in the process of price discovery. And in Sri Lanka specifically, if you've seen listings in the past, most companies go at a slight discount to market. Now, a slight discount to market would result in a higher dilution, yes. But the higher dilution might be 2% or 3%. But what eventually happens is if you've gone at a discount to market, the market would see that and then take your price upwards. And sometimes the market takes the price upwards of more than what you expect it to be. So the price appreciation that you can get from your shares, say for instance, you're diluting 20%. The discount might take you from 20% to 23%. But you remember, you still hold 77% of the business. And your value is essentially in increasing the 77%, not in trying to keep your share at 77 or 80. So which is why I initially said, although it's in the primary markets that you raise funds, it's the secondary markets which actually add value to a business owner. So let's start thinking about that more as opposed to a 1%, 2% dilution because of a discount. Then, of course, we go into a prospectus building stage or a book building stage where we do a prospectus, put all details of the company, go to investors, speak to them, whilst also processing or applying to the regulators to eventually list your company on the stock exchange. So this process generally takes about 6 months if you're ready to do an IPO immediately, but a lot longer if the company is not IPO ready. Now, these are some of the things that investors would look for and how to prepare in terms of an IPO. So one thing that investors look for at the point of IPO is how strong your financials are. Now, when I say how strong your financials are, it's two different things. One, they would see whether you're performing consistently or whether you have been performing consistently over the last few years. Two, how accurate are these financials? Is it done by audited by a KPMG? Is it audited by an EY or one of the big four? Or is it audited by your uncle's nephew's friend who is not recognized by the CSE? So when I say strong financials, one, you have to show your performance over the past few years. Two, those performances have to be vetted. Then there are two things which may look similar but it's not. One is operational scalability and next is the growth narrative. Now, growth narrative could essentially be, yes, I made X amount last year. This year I will make this amount. Next year it's going to be 25%. The year after it's going to be 20%. Operational scalability is an entirely different concept where, yes, you're doing something right now, but what's your next thing going to be? Now, if I was to take a recent example, when PickMe came to the market, they were mostly in urban areas like Colombo or Kandy. What's their next scaling event going to be? Is it either has to be they are going to a foreign country or they are going to scale in all of the other urban areas or all the non-urban areas or across the country. So in your business, what is that scaling event going to be is the operational scalability. Now, growth is a derivation of that. When you scale, yes, you would grow into that, but that growth has to be justifiable as well. So those are the three key elements when they look for, most investors look for in terms of evaluation. But they also what they also look from a risk perspective is how good your corporate governance is. So there are certain corporate governance practices that you must have if you're going for a listing. But even if you're not going for a listing, it's best to have certain corporate governance principles intact in your company. Like, for example, having an investment committee, having a remuneration committee. These are corporate governance practices that you could have even if you're not going for a listing, which would help you in the longer run. Now, how can you get to a situation where you can show investors that you have all four things? One, from a financial infrastructure point of view, implement whatever is required to be implemented at an earlier stage in your life cycle. I'm not saying go and pay for an expensive ERP when you start out, but as you realize you're going to grow into that and eventually going to look at a listing, yes, get into that. Get your books checked by a verified auditor. Then in terms of corporate governance, even if you're not looking at a listing in the immediate term, start looking at what the corporate governance principles are and start implementing some of those even before you start looking at a listing. Then in terms of business metrics, now to sell a growth story, you should have metrics measured not at the point of the IPO, but over the last 3 or 4 years, because it's your metrics that's eventually going to sell your story. So measure those, start measuring those metrics at an early stage in your life. Then legal readiness. Before you go for an IPO, make sure all of your IPs are intact. Make sure your cap table is intact. Make sure there is no one who's going to file a case after you go for an IPO saying, okay, I'm the legal owner of this company. I should be given X number of shares. Make sure all of those are out of the picture before you go for an IPO, because once you go for an IPO, you're in public domain. As a private company, a legal case being raised to tarnish your name is not going to have a big impact. But as a public company, it may have an impact, especially if it's closer to you trying to raise funds. So get those sorted before you go for an IPO. Now, if there were only 2 or 3 things that you should take away from this presentation, it would be: 1, know at what stage of the business you're in right now, because that is what should drive you in terms of what kind of capital you should actually be looking for. You have to balance both growth and control. Yes, debt financing can be cheaper. You won't be diluting any ownership. But if debt financing is going to put you in a situation where you don't have enough cash flows to run, because we've seen a lot of companies who come to raise equity, not because they need equity to infuse into the business, but because they need equity to settle a debt that they have taken, which has now become very expensive. So don't get into the situation of raising equity to settle debt. Get into the situation of having raised equity and having an optimum level of debt to have a sustainable business going forward. If you are looking at an IPO, start getting ready at an early stage. I'm not saying do evaluation now, but start putting things in place. If you're not measuring business metrics, it's time to start measuring business metrics. If it takes 2 months for you to see the first cut of your interim accounts or monthly accounts, it's time to start thinking, okay, maybe we should get it in 10 days after a month is done. Finally, leverage expert guidance. I see a lot of tech businesses where the owners are really good entrepreneurs, but eventually they do have to transition into a owner-led company to a manager-led company, which would require some level of guidance from your legal advisors, from investment banks, from the regulators. So you have to start making that transition prior to the IPO as well. I guess those are all the slides that I have. And I've run out of time as well, but would be happy to answer any questions post the panel discussion or once the event is over. Thanks.
Thank you, Mr. Vijayaram, for your insightful presentation and guidance on the boons of the capital market and how best to leverage upon them. Next, we shall move into the chief event of the forum, an expert panel discussion which will provide us with sharp insights into the advantages, challenges, and perspectives of public listing through the lens of several market experts. It is my privilege to invite the following panelists to take to the stage and share their perspectives. Dr. Hans Vijayasuriya, Chief Advisor to the President of Sri Lanka on digital economy and Chairman of the Information and Communication Technology Agency of Sri Lanka. Senior Professor DBPH Disabandara, Chairman of the Securities and Exchange Commission of Sri Lanka. Mr. Rajiva Bandaranaike, CEO of the Colombo Stock Exchange. Mr. Ashwant Vijayaram, Senior Vice President and Head of Equity Capital Markets at Capital Alliance Holdings Limited, and Mr. Jeevan Yanam, Chief Executive Officer of St. Anthony's Industries Group. And to moderate this panel discussion, I would kindly like to invite Mr. Banaka Harishchandra, Founder and CEO of Surge Global, to take to the stage and guide us into this in-depth discussion. A note to the audience. There will be a Q&A segment after the panel discussion. To submit your questions, please direct your attention to the QR codes on the screen. I now hand over the mic into your capable hands, Mr. Harishchandra, and members of the panel.
Hey everyone, it's very nice to see a pretty full room here and excited to kick off this session. Now, we have a lot of questions, and fortunately in the room we have everyone in the industry that we need to know about. We have everyone from the regulator, the team with the vision, the operators, the ecosystems, and the facilitators. It's also a very interesting subject for me because being in the industry myself, we've also toyed with this idea of potentially listing in the exchange. It's a journey that we are currently navigating in a conversation we are having. So I have a few personal questions that I want to ask as well. But without spending too much time, I'd like to kind of dig in and get started. First question is to Dr. Hans. Now, the digital economy is moving quite rapidly, and the markets have also kind of improved a fair bit over the last few years. What's your view in how these two things can work together and how it supports businesses from the early stage to the point where they scale?
Yeah, I think we had an excellent presentation now which took us through the life cycle and the capital raising modes and modalities available at each stage of evolution of a startup, whether it's a tech startup or a non-tech startup. What I feel is we have to focus on the problem to solve. I think the problem to solve for acceleration of the digital economy via resurgence of a very active startup ecosystem. The problem to solve is availability of capital and availability of the right type of capital, which, as mentioned earlier, has to be accompanied with a higher risk appetite and also laying the foundations of discipline and capital accountability for these startup businesses from seed to mature into investable public listed companies. But to be realistic, I think the public listing, unless you have a phenomenal growth curve and a maturity cycle, you're talking of the 5 to 10 year kind of second lap or third lap. So more I think about it, I feel we need to first solve for the real problem, which is the intermediary presence of risk capital in the market. And do the capital market players have a role to play? Definitely. And I think Professor and I have been talking a lot about this. If there's a way to bring the SEC into a position where the SEC guides and regulates the market intermediaries who would bridge to startup investors in the form of driving a venture capital environment in Sri Lanka. Multiple venture capital funds which are well capitalized, which have appropriate risk appetite, who have foreign investors in them, and they are able to intermediate between the formal capital market, high net worth individuals, private equity funds, etc., and the more risky propositions that the startups bring to the table. So I'll leave it there. I think we can discuss further, but I think we need to really focus on the problem. If you're looking at from seed to scale, we need to solve for the seed space.
So now, Doctor, you've helped run a fairly large public company, and having built a business from an early stage on my end, the idea of playing in a listed environment can be daunting, especially when it comes to things like the regulations and SEC. So this question is to Prof. Disabandara. How does the regulator really look at these early stage startups? So, in this context, when I say startups that have matured to the point that are capable of listing, they have the right revenues, they have the right metrics. But in technology, we've always had a culture of trying things out, breaking things, and asking for forgiveness later. when it comes to the SEC, I hear that's a slightly more complicated matter, and we can't necessarily do that. So, how should we potentially look at not breaking the rules, and how is SEC looking at technology companies venturing into this public space, and what kind of guidance or potentially reassurance can you give us as to how we should operate?
Thank you. Actually, we know in the Sri Lankan tech industry, we have been growing. We can see a lot of developments. And even in our industry, we have potential people. Even we can fight with the global setup, the regional setup. So we need, actually, SEC is looking at countries' economic growth. We know most of the economies in the world grow grow with the technological developments. So we want that happen in Sri Lanka, not in a smaller way, in a big way. So we need in Sri Lanka we need Google, right? We need Apple. We need more tech-savvy industries which can contribute more. So therefore, SEC, rather than a regulator, for this purpose, we look at this issue as the facilitator. So as a commission, we discuss this matter. And as a secretariat, it is very difficult for us to change our mindset because we look at the regulation. We need investor confidence, investor protection, and we look at the fair market. So those are our fundamentals. So when it comes to this area, so we try to find out way out from, how to help you, how to help this industry, while, as you correctly said, without disturbing the market fundamentals and the fundamentals of regulation. So what we try to do is, so we propose this forum here. All the stakeholders are here. Now all can deliberate what you want and how we can work. So say that openly. And as the regulator, we will see how we can help. So maybe we will be able to relax some of the requirements without damaging the perspective of Sri Lankan investor rights. So that's our fundamental. So we can discuss more, but just to set the foundation. So this is what I can say briefly.
That makes a lot of sense. And let's look at that facilitation element. Rajiv, this question is to you. Say I as a business decide that I want to go down the journey of listing my business. Who do I call? What's the first thing I do? And is it the exchange? Should we engage with the banks first? Where do we begin this journey?
Yeah. First of all, I think we are all enthusiastic by the kind of response that we have got today. It's great to see so much of interest from the tech industry. And you see, I think Dr. Hans Vijayasuriya set the tone when he spoke about seed to scale and at what point really you're ready to come into listed space. There's no universal timing for a company to come into public markets. But I think it depends on the level of readiness of your company. So internally, although market conditions may be great, there may be investor appetite, markets may be booming, you may be able to get the liquidity, you may be able to get the subscription. You need to be ready internally as a company to come into the public market. And I think you should be at that stage of growth where your company can really reach out for public funds, maybe debt, maybe equity. So Bhanuka, I think when you're considering capital and you feel that the capital that you have been working with your seed capital, your initial capital, what you have raised from your family friends, which you have reached out to banks, and you keep growing and you feel this is the time that I need to scale up, as we heard earlier with Ashwant's presentation as well. I think the first step would be bound to reach out to an investment bank or what we call as a corporate finance advisor. And there are licensed institutions to do that, where they operate within a certain framework. You need to meet them and start discussing your case with them. Listing, and it's a journey. It's a journey to get to a listing. And I think if you speak to some of the more successful IPOs, it's not something like a bank loan or a bank funding that you do it in a couple of months. You need to really prepare yourself. And therefore, I think that conversation has to start quite early with your investment bank. Discuss and prepare and start structuring your company to go public. So that journey has to begin probably initially with the investment bank. We have a separate unit within the exchange which will handhold you, which will guide you, will advise you initially. And particularly for companies that are coming in for the first time, and if you want to reach out to, as you heard, the Empower Board, which is a board that has been created for not the large companies, but the smaller companies. We will do also at our end some hand-holding to basically identify the most suitable options for you when you reach out to public markets. So probably our unit at the exchange and also to investment banks as a very initial step.
So you touched on a point that I think is very critical, and it's probably the biggest question that a founder will ask in this journey, and it's coming to structuring. A lot of the businesses that are here that are involved in technology doesn't necessarily service the local economy. They service businesses around the world, and they have access sometimes to capital pools around the world as well. This question, I suppose, could be addressed to anyone, but maybe I'll focus it first to Dr. Hans. How do we motivate a business to list in Sri Lanka? Because when it comes to structuring, a lot of technology companies today are structured offshore. It's structured offshore due to multiple things. One is capital is easier to find. There is no restriction of capital flight. And if you end up listing in public markets outside, you could argue potentially that there are higher valuations. Now, we've gone through a bit of an austerity program, and there are questions around tax and all of those things. You know, when you take all of these things into consideration, and when CSE and the government of Sri Lanka and the regulators come together, how do we convince the audience that the right call is to give up a listing in Singapore or a private exit externally in the US, set up a Delaware C Corp, and consider CSC as a viable alternative?
Yeah, I think you prodded all the problem definitions. So what the government is doing, team working on the digital economy acceleration, as well as Professor and the SEC, the BOI, and Stock Exchange also. First of all, identify the blocks and start unlocking one by one. So you spoke about companies listing overseas. Forget about listing. I think a lot of our startups, once they reach a certain scale, they would shift their headquarters outside the country because of capital availability and capital mobility and the pool of capital available in that country. So in the response to your first question also, I talked about the problem to solve is to create a capital pool. So I won't repeat that. But over and above that, I think capital mobility is very key, because especially in the tech industry, only very few categories of tech can build scale in Sri Lanka from the domestic market in Sri Lanka. So you might have the best innovation, the best idea, but can you build a large business using the domestic market in Sri Lanka other than a few categories? Telco maybe we have seen fairly, billion-dollar kind of scale, but it would be hard. So therefore, a majority of your capital and a majority of your effort has to be quickly scaled outside Sri Lanka. So that's the dream of having Sri Lankan IP, Sri Lankan headquartered companies becoming multinational. That's when the digital ecosystem in Sri Lanka will really fly, and capital will start coming in, venture capital, etc., to fuel these Sri Lankan companies, Sri Lankan IP to go overseas. To make that possible, you need to allow for capital mobility, and that is something which I think we'll hear some good news very quickly, very soon rather, where there would be special facilities for FDI flowing into Sri Lankan startups to be fully mobile, meaning that the capital can be used to invest overseas and expand your business overseas, provided you keep your IP and headquarters in Sri Lanka. The second piece is around taxation. And the scenario we have today is that for venture capital funds and investors in venture capital funds, and you can have multiple tiers of venture capital funds, you have cascading tax, which is not the case in some other overseas markets like Singapore or even India. Therefore, the propensity for venture capital funds to set up in Sri Lanka and less so for them to bring foreign capital into the Sri Lankan ecosystem, we have to solve for the cascading tax. And that is something which the SEC is playing a key role to formulate and make the required changes in legislation to remove that cascading tax. So these are, I just mentioned one or two. But I think you took the right approach and of going to the problems. And if we can start with attracting capital into the venture capital space, creating an environment where our own innovators are sufficiently motivated to stay in the country and operate out of Sri Lanka and expand overseas from Sri Lanka, then I think we'll have a much more vibrant tech ecosystem. And the path to getting to that scale where you start listing will be shorter, I believe, in such an environment. Maturity curves will be shorter, and also the readiness for the full scale capital market would be much greater.
So, question to Jeevan along those lines. I think Hans mentions the story about the innovators and ensuring that there is sufficient support to keep them within the country. You have a home to those innovators where you help kind of build and nurture a lot of startups. What do you think the actual gap is? Is it just capital? Is it ideas? What can we do to kind of help bridge those gaps?
So I think the two main problems, I think, which any startup faces in Sri Lanka is access to capital and access to market. These are the two fundamental things that at Hatch we try and first get startups to try, forget about going to market and everything else, just build a fundamentally strong business first, right? Make sure that they are able to find product market fit, they're able to successfully start scaling, and then we see capital markets, whether it's VC funding, whether it's capital markets as leverage to kind of grow their business, right? So whether it's leverage to find talent, whether it's leverage to find market access, whether it's leverage for tax, all the things spoken before, we see, or what we try and tell our startups, first build a fundamentally strong business, find product market fit, then start accessing capital and look at capital as leverage. And obviously a lot of startups, when looking at the stock exchange, et cetera, are thinking about, issues about control and various things like that. And we say, look, if we try and frame the narrative right, once you reach a certain stage of maturity, going to capital markets is probably the best thing to do, because actually in the stock market, you might actually be able to retain more control than you will if you're going to, and say, an early stage investor, right? So we try and facilitate for startups a proper kind of growth journey. And of course, it's not every startup, as you were discussing, can necessarily, of course, will always have a home here, but if they have markets and better valuations in, say, markets like Singapore or Dubai, we say go there, but always think about, always have a home here too. So we go where best kind of your startup is going to help grow and grow itself. Yeah.
So in terms of supporting those startups, next question is to you, Ashwant, right? You did a wonderful presentation, kind of walking everyone in the audience across the journey from what size they should be, how they should look at an IPO, the different sources of funding that they can get, and really all the potential opportunities and the pitfalls of that process. Now, the role of an investment banker is to really play that role of an advisor, kind of someone who's fiscally responsible, who helps that founder navigate through this journey. As a founder, when they engage you to kind of discuss this process of potentially listing, what kind of value does an investment bank bring? Because I think a lot of the companies here that have tried to raise money, some of them may have gone through investment bankers, some of them may have done it privately. What is that conversation like? What is actually brought to the table? What do we not know about the investment banking space that they should probably know before they have that conversation with you? What can they expect?
One of the biggest challenges that I've seen is, and that's a localized challenge to Sri Lanka more often than not, is that at an earlier life cycle of the business, sometimes you're trying to place a company with an investor who ideally should be coming in at a later phase of your life. What that does is kind of mismatch the investors' expectations and the company's expectations as well. Like I said, the earlier kind of guys who should be coming in should be more risk tolerant compared to the rest. But sometimes in Sri Lanka, because in all reality, venture capital funds or angel investors in Sri Lanka for a startup ecosystem is few and far in between. So you're going to have to find the right guy at that early phase in your life to invest into your business, and that's ideally something that an investment bank should be helping you with. Now, if you're looking at a later stage in your life and how an investment bank could come in to help you, it would generally not just be a discussion about who would I place your company with, or where would I, it's not just a matter of where would I place your securities with, it's also a matter of how would I go about doing it? How would I go about structuring it? So that's a discussion that can only be had at a later stage, whereas in an earlier stage, the discussion would be more around who would I try to place this company with. But in all honesty, if you're trying to get the kind of valuations that a company, say in the US or a company in Bangalore is trying to get, you ideally should be targeting those kind of investors as opposed to targeting only local investors. And the biggest pitfall that some people get into is to target just the local investors and then think that the valuation that they should be getting for the company is what a local investor is willing to pay.
Thank you for that insight. I think part of the valuations locally are probably just tied to the fact that those investors don't have anywhere else for the money to go, so it becomes a proxy for your business. Now, kind of going through this listing journey is a fairly long one. I think what you mentioned was a best case scenario of 6 months where everything is ready, you have your books in order, you have your processes in order. But in reality, it's probably a year plus for most of the businesses out there. Now, the markets had a pretty good 2 years, I'd say. Everyone has had great gains, the valuations have been great, and anyone who has participated in the markets over the last couple of years had seen that upside. But the problem is the audience that's looking at listing today aren't going into that rally. They're going into a future which we may not know exactly what it is. If you're looking at the US markets today, you're seeing SaaS companies sell off at record levels. I think SAP is down 10% yesterday, Oracle's down 5%, and it's a bit of a bloodbath out there. So, Rajiv, this question is to you. For a founder that's looking at listing, how should they potentially weigh in this volatility? How do they, when you're in the private markets, for us, we did a raise about 8 years ago. No one is walking to us every day and saying, hey, today your company went up, tomorrow it's down, and you don't have that pressure. How does a founder that's busy fighting their day-to-day, getting customers, keeping them happy, driving revenue, focusing on profitability, it's a completely new dynamic now to go ahead and say, oh, your company valuation went up or down. Materially, the fundamentals may have never changed. How should they look at that?
Yeah. So I think primarily we get back to basics as to why a company would really want to come into public markets. Why would you want to list? So quite apart from this aspect of getting the capital into your company, there are other reasons why you would consider listing. You're unlocking value of your company and you're discovering a price for your share. So by listing, I think Ashwant shared the many forms of the different listing experiences. You can raise capital, new money into your company. You can exit your company by selling a part of your shareholding and take the money to yourself. You can list the company as is through an introduction without really issuing any new shares, but merely perhaps for different reasons, maybe to, as I said, discover a price for your share, unlock your value. Maybe your partners want you to list, maybe you want brand value, etc. So markets, the second aspect of it, markets are cyclical. Markets move up and down all the time. And I don't think as a owner of a company, you should worry too much about short-term volatility. If your company has a good, strong growth story, if your company is profitable, there will be always a demand for your share, and we have seen that in the market. We have seen the ups and downs, short-term volatility, but we have also seen the better companies outperforming the indices as well and performing well even through tough times. So I think as a founder, you need not start looking at your share price every day. You need to watch it. You need to keep a good eye on your secondary market price for sure, because that gives you value. But I don't think you need to really worry about the ups and downs of the market far too much, because you have gone into the market with a purpose. You have unlocked the value of your company. Probably you have realized the valuation that you want. So in terms of post-listing experience, you will find that by delivering value to shareholders, you have an obligation to give some form of return to your shareholders by way of dividends. But if it's a growth company, you can give it by way of the gains, the capital gains that you offer in the market by the share price appreciation. I think you need not to really look too much as to the secondary market volatility if you're worried about the ups and downs as you really mentioned. So listing ultimately is about unlocking value and see what value you can get for your company. And if you can derive that, if you have got that, I think you can be happy that you have made the right decision. Of course, as all our panelists said, the right timing. The market timing becomes quite relevant and important that you come at the right time. And then again, there is no universal right time for the market. Even though markets are at different stages of development, if you have a growth story, and I think Jeevan alluded to that, if you have a good story, if you have a good growth story and potential, and there is appetite, investors will buy your share. Investor will always make an offer for your share. Investor will keep that price going. And I think if you look at the 287 companies that are listed, you will find that companies that have good growth, good value, will be able to maintain a good share price as well.
So, volatility aside, the other thing that founders typically lack is governance, because early stage technology, especially governance, is the last thing that you're worried about. So this one's to you, Jeevan. Of the businesses you've advised and you've invested in over the years, how do you ensure that discipline is maintained? Because when we started and we had to do the first audit with KPMG, it was not a fun exercise. And I think for most businesses and founders here that I presume have gone through that experience, it's not something you want to do often. And now you have to do it every 3 months, file interims. How do you build that discipline? I feel like it's a muscle that you need to work on.
Yeah, good question. I think a lot of startups, especially when they first start, are just focused on making money, right? And their objectives aren't really looking at the monthly accounts, etc., right? So what we face in Hatch is, bringing in some of that initial financial governance and financial discipline, right? So before the Hatch Fund, whether it's at pre-seed, seed, we kind of introduce, a must-have is someone doing your financials and giving you a monthly financial statement to the startup, right? Not just for our benefit, but also the startup's benefit, because they need to know where they are and at what stage they are, growing in the company. And I also think when you kind of take a step back and look at the wider industry, this kind of practice is really useful. You probably heard of cases like Theranos and eFishery and all these global things where big VCs have invested without doing due diligence, and then later find out the numbers don't match, right? So I think as an industry, I think if we just take the practice of just simple financial discipline, we introduced that very early in a startup that we are bringing through either our accelerator incubator programs or even into our fund. We make sure that they have a data room, right? Because it's funny, when the eFishery guy got caught, his excuse was everyone's doing this. And then everyone was like, what? Everyone's doing this? And no one really knows, where the ground is, right? So it's really, I think financial discipline is a must, and we try and introduce it as early as possible, because it's exactly what's going to, we try and reinforce this loop, right? Because if you're able to build trust, you have, financial discipline gives you trust gives you access to capital, capital gives you leverage equals growth, right? So we try and enforce that into the startup mindset and say this is how you can build it.
Hopefully no one here is going down the eFisheries route. It was not a great story. So to Prof, this one is to you. Now, how do these kind of governance standards really kind of help grow these businesses, right? Because there is a certain level of quality a business gets when it has that level of transparency and reporting. How does being listed support those organizations?
How does governance support?
Yes. Beyond purely, the prevention of fraud for investors, how does it really help the founder?
Now, when you say governance, basically 3 major principles. You have to be accountable.
transparent, and transparent, accountable, and you have independence. So when you have these three pillars, there are more other. So when you are accountable, that means what you do, you must take the responsibility and report it. And always try to show what has happened actually. So it should be seen very clearly what has happened. And due to any influence, decisions or the relations must not be disturbed. So those things are, very basically, if I take all these fundamentals, so those things must be established rather than rules and regulations. Rules and regulations are there. So SEC regulation, listing rules are there. So just complying rules is not governance. Governance is basically you have to comply with these three. So then anyone can, as he rightly pointed out, so finally that is trust. So anyone can trust that things are in order in all parameters. So trust is the basic case for the investor. So investor will come and put his hard-earned money only when he or she can trust you. So I urge this crowd, right? Because we are about to, if we are really, we have a lot of reasons for listing. But if you are seeking for growth, my target is as a person, responsible person in this nation, I am looking at the growth requirement of this country. We are at 5% growth. What I think is we need 7, 8, 9%. For that, what is needed is capital. Capital is lacking. So my institute is basically for capital formation. Capital markets are capital formation. So capital is only you can formulate capital when you have a credible, trustworthy market. So let the investors to come, right? And at the same time show others that people can trust you. So build your business up to that level. Your growth story is one thing. At the same time, similarly, in parallelly, develop a story that people can trust you. So that is what is needed. So forget about all these difficult terminologies. Forget about transparency. Forget about governance and all, right? Always see whether the people, those who come and invest, can trust you. If you can establish that one, we are there. So you don't want much regulation. So that is the framework we need. So up to that level, we are flexible as the regulators, right? We are dynamic. We are dynamic with the market dynamics. So come and formulate your business module. So formulate your business ecosystem. With that, we are ready to regulate something for you without disturbing the trust levels in the market.
So play the role of the guardrails, but not really block anything from happening. Now, we're running out of time. I have one more question I want to ask. This one's to you, Doctor. Now, you're involved in government as an advisor to the president and has a fairly large amount of insight, more than anyone else here. I'd like you to paint us a picture 3, 4, 5 years from today. What can the community here expect when it comes to their business, the economy, and how the role that digitization has played in order to enable all the entrepreneurs in this room to kind of take their business to where they need to go?
Yeah, so multiple dynamics behind that vision of getting a multiplier of 5x on top of where the digital economy is today. From around 3 to 4 billion, lifting it to the 15 billion kind of level. Now that kind of uplift comes with digital transformation pervading multiple sectors of the economy, meaning that every sector has to digitally transform, whether it's transport, tourism, health, agriculture, etc. So that translate that $15 billion and the path to that 15 billion from 3 to 4 billion today, and if you add up each year, I think you'll come to a number of around 25 billion over a 5-year period. Now, who is going to take that work? Part of it, those sectors will take it as efficiency, as productivity, as profit. But the IT industry and the innovation industry and digital transformation talent pool will take a major part of that pie. And that is what our, not only startup, but our mature IT sector as well, has to position to take that business. And the only way to take that business is to keep innovating and help Sri Lanka advance to the next level of digital utility and digital methodologies. It could be AI, it could be IoT, it can be Industry 5.0, etc. So the pie is going to emerge and you need to capture it. Now, why would this pie emerge? One is the government's trust and focus on digital as a tool to drive the overall economy. It's not just an IT project. There's a strong commitment to use digital to drive the economy. And therefore, there would be enablers. Government will be a platform for the private sector to perform. That's a fundamental. The second is that we are focusing a lot on building those horizontal rails. They're called digital public infrastructures, the digital ID, for instance, data exchanges, the ability to share data and interconnect various institutions, all that is being put in place. So these put together will provide that platform and enabler for the private sector to innovate. And also the government has a strong commitment not to, or to play as thinner role as possible in this whole game. Be an enabler, but let the private sector take the volume of the business and of the activity. So for that, I think two hands to clap. The enabler is one, the other is the innovator. And we are also working on the procurement environment to enable as far as possible for smaller and smaller companies to participate in government business. Because today, doing business with the government for a small company may be tough, but we are trying to also alleviate that. And along with the SEC, along with the BOI and other institutions, we are also working on the capital formation process for smaller companies. So I can speak a long time on this, but I think time for audience questions. So thank you.
Thank you so much. Do we have more time for audience questions? Because I realize a lot of them are coming in.
Maybe we can do a few questions.
Okay. So, question in terms of the SEC, right? Since the biggest problem is capital at the early stage, I suppose this may not be entirely relevant at an SEC level. How will the SEC help to solve that early stage capital issue?
Yeah, that's why, I said, we will discuss. Now things will come out. So now we can say lower capital. What is the lower level of capital you discuss? Now we have the Empower board. Empower board is 200 million, right? What's the minimum capital? 25 to 200. 25 to 200. So if the capital you talk about is less than 25 million, we'll discuss. And even we can think about how we can reduce it to a level, maybe 15 billion. So for example. So only thing is we have to formulate it. For that we need to deliberate. So that is why I say we will discuss. So we have already thought of one step forward. If the Sri Lankan tech sector is really wanted and to formulate capital through the Sri Lankan capital markets, we are ready to even consider introducing a separate board for you. So then there will be relaxations in relation to the capital limits, then some of the governance requirements, some of the rules. So we can consider. But it doesn't mean that we will be relaxing entire thing. But if you think that Empower Board is too far, then we will give you a customized thing. That means the easiest way. So I think I answer your question.
Some of these questions are the type of questions I send my accountant, but Ashant, I'm going to give this one to you. When we get investment and we spend it on product development in technology companies, should we burn it as operational expenses or to reduce taxes, or put it on the balance sheet as an intangible asset? I feel like we are treading the lines of IFRS compliance, but
Going based on IFRS, I guess if there are any actual research expenses, then you can expense them. But if you are using it for product development, they technically should be capitalized and then depreciated over time. But that's just the IFRS that I just restated here.
this question is why you have to have an auditor. It's their responsibility to kind of help you go through this every year when you file your taxes. They will, on your annual returns, they'll kind of sit with you, walk with you through the numbers and explain what can be done the way you think it can be done and what can't. We've got just another question. About increasing the value for potential Sri Lankan IT organizations, right? What are the benefits that local organizations can get over foreign companies by, I presume, on the listings itself? I think it kind of ties back to that earlier question of why should we set up headquarters in Sri Lanka?
Yeah, so the why has to be actually answered by us, meaning we have to create that environment to answer that question, the why. Like I said, the government has to be an enabler. So we have to create the regulatory environment and the taxation environment, which I still maintain, first stop, we have to attract venture capital. We have to have more venture capital funds in Sri Lanka. And that's a space that SEC can help to regulate and formulate, because, and that's a discussion that we are having now, because just like the SEC has the unit trust structures running, similarly, having regulated venture capital with the right taxation flows and removal of cascading taxes can attract more capital, and that will answer the question why, because you will have enough capital here in Sri Lanka.
I'll also give a possible scenario. Right? I think most startups, when they're starting, are solving a problem that they can see, right, or have some kind of perspective on. So it's going to be, you're going to be solving a local problem, and of course that technology that you build or product that you build, you can then possibly take it global, right? So I think at the very initial phase, looking at the Sri Lankan stock market and proving yourself in your home country, right? And then possibly then looking at another listing, whether it's in India or elsewhere, could be the next stage, right? So I think there's always a strong possibility of looking at even dual listing as an option once you've proven the product locally, right? So that's an option as well.
If I add my 2 cents to
Please.
it, I think if your business may be even based here, but maybe you say servicing overseas market, there is a home market advantage. As Jeevan quite rightly said, it's not that easy to access foreign capital markets at the initial stage, because the compliance requirements, the cost, and that their requirements may be somewhat stringent. So probably it's an easier start in the home market And there's always possibility of a dual listing. You take it elsewhere as well. And wherever you go into a foreign capital market, the fact that you're listed in your home market will be a distinct advantage because you're already a regulated and proven entity. The transparency, the level of disclosure is already there. So they'll be comfortable in permitting your company to list. So probably there is an advantage.
And I'll add my 2 cents here as well. In terms of the home market, so we've gone through a journey where we've bought out our primary shareholders back in the day, and we are potentially exploring a listing. And we looked at 2 markets. We looked at Singapore because we have HQ there as well, and then we looked at Sri Lanka because our teams are based here. So there's 2 things that came into mind. One is in Singapore, we have a size requirement where we would actually meet the Singaporean listing criteria. But at the same time, then we have to take into consideration that no one really knows who we are over there. Sure, we'll have a valuation, which is an earnings multiple that would look okay. But in Sri Lanka, we would probably, so because we are not local, we would probably get a discount on our valuation. Whereas if we look at the same numbers in Sri Lanka, we would probably get a premium to our valuation because people know who we are, they've seen the story, it's easier to convince the growth. And alternatively, like Ashwant mentioned, the tax implication is material. As a founder, at some point, you are listing your business as a liquidity event where you are able to potentially divest some of your equity. And eventually, even if you're selling it at a premium, if you get a 20% market premium and you have a 30% capital gains tax, you're better off not having the premium in Sri Lanka if you choose to live in Sri Lanka, because your net return, because of the current structures and the benefits of Colombo Stock Exchange, are financially superior in most cases. Few more questions coming in. Oh, that's me being told to wind up because all of you are going to be spending a lot of time with each other, and there's refreshments outside, and I think it's a fun way to session to network, talk to each other, express your concerns. You have the regulator, you have the operator, you have all the stakeholders here. So with that, thank you so much for coming, and thank you for having me. It's been a wonderful session.
Thank you, gentlemen of the panel, for providing us with great insights on the capital market for tech leaders through such engaging dialogue. I would kindly invite the panelists to remain on stage as we proceed into the next segment of this evening's program. As we conclude the key event of the night, we here at the SEC and CSE are pleased to present tokens of appreciation for all the contributions made not just tonight, but institutionally for the good of the Sri Lankan capital market and wider business community. I kindly invite Senior Professor DBPH Disabandara, Chairman of the Securities and Exchange Commission of Sri Lanka, and Mr. Rajiva Bandaranaike, CEO of the Colombo Stock Exchange, to present these tokens of appreciation to Dr. Hans Vijayasuriya, Chief Advisor to the President of Sri Lanka on Digital Economy and Chairman of the Information and Communication Technology Agency of Sri Lanka. Thank you, Dr. Vijayasuriya. In addition, a token of appreciation to Mr. Jeevan Jnanam, Chief Executive Officer of St. Anthony's Industries Group. Thank you, Mr. Jnanam. A token of appreciation to Mr. Banaka Harishchandra, Founder and CEO of Surge Global. Thank you, Mr. Harishchandra. And a token of appreciation to Mr. Ashwant Vijayaram, Senior Vice President and Head of Equity Capital Markets at Capital Alliance Holdings Limited. Thank you, Mr. Vijayaram. Thank you, gentlemen. You may kindly take your seats. forgive me, a moment for a group photo. Thank you, gentlemen. You may kindly take your seats. Yes. I would like to once again thank the panelists of tonight's in-depth discussion and all of you, the members of the audience, for engaging with us as we explored how the IT sector can seize upon a rising capital market. As we conclude today's event, I invite you to please enjoy the cocktails that will be provided and utilize this opportunity to network and engage in collaborative dialogue. Avail yourself of the opportunity to meet with the members of the SEC and CSE and make the inquiries to start your path in the capital market, not just tonight, but hereafter. Additionally, please note that a QR code will be provided on the screen, which I kindly invite you to use to provide your feedback on tonight's incisive discussion. Ladies and gentlemen, we thank you for your participation and hope tonight's discussion has been illuminating. Thank you and good night.